Okay, so as I said, thanks everyone for joining. This is the first webinar we're doing to really just explore some of the interesting topics. We get lots of feedback from people saying they just want to understand a bit more about the tools and how exactly we're using them. Right, trying to find maximum edge from the advanced plan and really try and use these tools to navigate what are increasingly complex and dynamic markets. One of the beautiful things about Bitcoin is we can visualize what's going on, and you'll often hear me talk about whether you listen to the videos or you're reading the week on chain reports that we put out. What we really try and overlay is this element of human psychology, and that's kind of the structure I really want you to come into this with. It's about human psychology, and we're visualizing it playing out in the data as it happens. So the topic of this particular session is how we navigate late stage bear markets. Now, that's not necessarily to assume that we're in a late stage bear market, although it has many characteristics that we've seen in the past. But what we're going to do is use a bunch of tools to assess and really try and gauge from a couple of different areas and a couple of different concepts and topics what may be going on under the surface. So just before we get started, I'll do a quick housekeeping things. So what we're going to do is about 30 minutes of content. I'm going to take you through a series of metrics and dashboards. Some of them you may have seen, some of them are more kind of the components of it. What I really want to do in this session is a bit more about the theory, the question of why, not just that's a metric, that's kind of the what. I want to explore the why. Why did we select these particular metrics, and what kind of edge and advantage do we think that these give you? So we do have a Q&A section open. So it'll be 30 minutes of content. There'll be 15 minutes at the end where we'll answer any questions that come in. There is a Q&A section. So if you do have any questions, please put those in there in the chat box there, and we will get round to those at the end of the session. It is going to be recorded. So if you do have to drop out or anything else, we will forward this around. So there will be a copy of this afterwards. And just as a key reminder, everything that we touch today will be available, and it is available for our advanced plan. Advanced really forms, I mean, for me personally, probably something like 85% of the analysis toolkit that I use. There's an immense amount of power in there. We're constantly finding new concepts and ideas. Certainly our dashboards and workbenches is how we're building and shipping these kind of interesting concepts and ideas. But as I said, I want to bring this particular session with the focus on late stage bear markets. That's kind of our end goal. But I really want to use this as an opportunity to introduce some of the concepts and the theories, and really so that when you ask the question of why should I look at these particular metrics, that's essentially what I want you to take away from this. And as always, you can always reach me if you need on any of our channels and comments and the like. If you haven't used Glassnode Forum, by the way, you'll find that in a tab in Studio. Glassnode Forum is open to anybody with an advanced or a professional account. You can essentially message myself or put a post up there on any questions or metrics that you have. And myself and my team will jump in and give you a hand with those. So we're always looking to ask questions and answer where we can. So the topics we're going to go over is how we identify a bear market, right? What are some of the characteristics that initially, what does the shock wave look like that puts us into a state of bear market territory? And really what's probably more relevant to right now is what are the metrics and signals that we're paying attention to for the turning of the tides? When do you start seeing things that actually start reversing back to the other side? What's the behavioral shifts that we're looking for? And how does that play out in the data itself? And then what we're going to do is show you a bit of an actionable checklist, which is really just a suite of metrics, but think about it beyond metrics. Think about it in terms of concepts, in terms of buckets, and we will break that down into those different buckets along the way. And really, it's about trying to make the most informed decision that we can using the data that we have available to us. And in many ways, I look at on-chain analysis, it's like X-ray vision. You're sitting at the poker table and you can see 30% of the cards because you can see the behavioral patterns as they happen en masse. Anyway, that's kind of the framework I look at it. Right, so that's kind of the intro. Let's jump in and actually look at some of the dashboards. So this is a dashboard that's kind of going to be, this is the end result. Back when I was back in high school, I had a maths teacher, and he showed me this concept. He taught us a little bit of mathematics a year ahead of where we actually were, and he called it a look through the window. And the concept here is that showing people the end result and just kind of talking about some of the concepts and the ideas first, and then you go back and actually study them. By the time you get to that end goal, your subconscious and your mind has kind of processed that idea, You've kind of thought about that initial seed, and then when you finally get there, you're just that little bit more familiar with it. So this is essentially going to be our look through the window. This particular chart is kind of the end goal that we're going to get to. But what I want to do is actually take it right back and look at the different components to go into this. So what this model is doing, this is kind of a distillation of 8 different metrics, which are broken into 4 different concepts, on-chain topics, let's say. The purple is looking at supply. What does the supply dynamics look like? Who owns what? Do we have a hodler-dominated market? Is there enough inflowing demand? The blue is looking at profitability. Are people realizing profits? You may have heard in recent videos, I've been using the term, no one cares. When you're, no one wants to tell their friends, hey, I lost all this money yesterday, right? People want to say that, the word of mouth and just general human happiness tends to happen with green candles and less so with red candles. The yellow is on-chain activity. That is the network alive? Is adoption growing? Are things improving? What does that actually look like at that level? And then the green one is just pricing models, right? And with the reason we've selected the pricing models that we have is really about human psychology. So that's the layer. This is the end prize that we want to get to, where we have as many of these things firing off at the same time as we possibly can. And the idea here is we're looking for confluence. Do we have multiple metrics across multiple concepts that are all telling us that things are starting to turn around? There's a bit of a tide. And you can see we have got a bit of an upside momentum. And now we're going to explore the concepts as to what that actually looks like and why this is happening. Okay, so this is going to be our bread and butter dashboard for this particular session. We will be sharing this around. It'll come out with the recording, so you will get access to this following this webinar. And we'll actually put the webinar inside this dashboard, so you'll be able to refer to it along the way. So there's 2 pricing models that we selected. And really, they come back to what are the most relevant, psychologically relevant, widely observed pricing models that we have. Well, every man and his dog knows about the 200-day moving average, whether you're from traditional finance, whether you're from commodities, whether you're from Forex, whether you're from the crypto space. The 200-day moving average in this blue curve here is one of the most widely observed technical indicators that exists. Many people look at it purely as a bull-bear indicator. So you can see back here in May 2021, when we broke below that level, and the oscillator down here is just the Mayer multiple, which is just the simple oscillator for it, helps you understand extensions, which, by the way, if we go back to even the early years of Bitcoin, the 200-day you will find tends to signify these turning points. This is before Bitcoin even had a price chart. The 200-day is a psychological thing. Human beings have this, it's got to do with how long our memory is, when we last bought and sold coins. It's just people have an attachment to this kind of time frame of about 200 days. And then you add in there the layer where every technical analyst in the world pays attention to it. Many asset allocators look at it and say, if below bear, if above bull, as kind of an initial litmus test. And you can see that once we break above in 2019, we spend most of that time above. 2020, we spend most of the time above. And breaks below tend to signify there's a bit of a regime shift. So as a result, breaking above the 200-day, which we did, I think, last week, it's at the very least something to pay attention to, right? Something changed that is different to every previous rally. We saw up here in March 2022 that we had that retest. We had retest all the way through September, but this one here had a true break above, and it's so far held. So that's the first kind of indicator that something has changed. Something is at the very least different, and lots of people saw it. Now, interestingly, the realized price, this is what I would say is kind of the most important both concept, but certainly indicator for the Bitcoin space. And that's because, like the 200-day, it is widely observed. Lots of people pay attention to this thing. And it is essentially the cost basis of the entire market, and it tends to show up as a form of floor model. Now, what we saw here is that we simultaneously, I think the 200-day was at 19,500 and the realized price was at 19,700. So in one move, we essentially blew through both of those models, and that puts the technical side, we've broken a psychological level from a technical side, but simultaneously, the MVRV is now back above a value of, well, here I've subtracted it by 1, so we can get this nice oscillator in Workbench, but it's broken above a value of 1. So what that means is that the average Bitcoin, right? Now, remember, there's going to be coins, right? I've got UTXOs that I bought at 50,000. I still hold those. They're certainly underwater. But if you take the average across the entire market, and by the way, this includes Satoshi and the lost miners and everyone, If you take an average across the average BTC, are they in an unrealized profit? And the answer is yes. Now, we can do a series of other checks, and there's other models we can look at. It's a story for another day. But looking at whether that break above, like the realized price, it's probably more of a floor model in the sense that because you've offset the amount of losses in the system have actually offset the tremendous gains held by Satoshi and early miners. We have tools, and there's a bit of research ongoing to try and explore this idea further. But suffice to say that breaking above that psychological level, it's like the 200-day. It's widely observed. Lots of people see it. And as a result, it has that extra significance. So you've now got two pricing models that are psychologically driven that we have some upside momentum on. So that's the pricings game. And the pricing model, they're fairly conservative, right? What we're just looking for there is kind of a binary above, below. Very, very simple. But the core concept is lots of people are observing those models. The on-chain activity, this one here is where we start to get more into the on-chain space. And this is probably one of the most important categories, certainly for Bitcoin, trying to understand momentum. Now, you'll see us using these things called new address momentum, new entity momentum. The concept of momentum is just looking at the red curve here or the pink curve. This is our entity adjustment, so new entities. This is our T3 variant. And the reason I've got this here is just to show you the difference in compare and contrast these, so you can kind of see how they work in tandem. So we've got new addresses, and when we talk about momentum, the red curve here is the monthly moving average. The blue curve is the yearly. So very, very simply, if the red curve is above and the higher it is above the yearly, it's showing that over the last month, the blockchain has been more alive. There's been more activity than the last year. We're just comparing the current behavior to our yearly behavior. So really, it doesn't necessarily matter so much what the absolute value of these things are. The bigger the distance, the better. But for the most part, what we care about is the red curve above or below, and how convincing is that? So we can see here in 2018, this break above on the monthly triggered, even though price was bearish through most of 2019 and 2020, it signified there was a growing underlying strength in the network, which actually then gave rise to our 2021 bull. You can see that we come back down and retest this thing several times, but note here in the 2021 top, this first top, this is when I argue the bear market started. And this break below, this actually happened before our major sell-off. We're seeing that the monthly behavior is deteriorating relative to the yearly. And this is actually a very, very common behavior. Let's actually zoom out on the all-time here so you can see, note the collapse in 2017. These massive shock waves. This is a good sign that something has happened where breaking above the 200-day is psychologically good. A breakdown in our overall transaction activity like this is normally a sign that there are dark waters ahead. So a very, very good early indicator that things weren't so rosy. The second thing that's quite interesting, note the peak that we had here in February, January 2021 compared to our November all-time high. Massive bearish divergence, higher price, way, way less activity. So what that's telling you is that the network is more dead than it was, even though price is higher. Gives you that bearish gauge to start thinking about, okay, maybe I need to start thinking a bit ahead and there could be some scary waters. Now, if we look at our current situation, we have broken above. The monthly has a bit of upside momentum at the moment, initially sparked by FTX blowing up. Likewise for our active entities, which by the way has broken back down below, but is starting to form a bit of a basing pattern. So this is kind of in this state of flux where we just need to be paying attention to this particular model in the sense that we have that initial burst of activity. Quite often things like an FTX or a big disaster, it will trigger a psychological shift and a psychological change. This is the kind of model that we want to be paying attention to. Does it actually stick the landing and keep going? Or do we have this kind of slow grind that we had in 2019 that, you know, it's trending higher, but through most of the 2019 bear, we can see that there really wasn't much momentum. It was kind of just tracking along the yearly. It's when you get these explosions higher that you really get that upside momentum. So at the moment, we've got something to pay attention to, but it's not exactly something to write home about. Now, that's active addresses. That's kind of one component, but we all know that active addresses and transactions, there's only so many that the blockchain can handle. Bitcoin has a limited throughput. So we also have to look at when you reach that throughput limit, right? When blocks are completely full, the release valve is then fee pressure. So that initial burst of activity we will see in things like transactions, we'll see in active addresses, but we won't see it beyond that point. Once we have full blocks, those metrics will start to cap out. There is a linear limit to how much they can handle. So what we've got here is a statistical normalized tool. This is the Z-score. Now, we've got this on a 2-year basis. The reason it's on a 2-year basis is that gives us enough time for the bull cycle to come in, the bear cycle to come out. But what we care about is within the bear cycle, right? As we come towards the end of that bear cycle, we kind of want to see, are we improving relative to the bear cycle? Because obviously in early stage bull markets, late stage bears, when that first sign of fee pressure starts to come in, of course, it's not going to compare to the bull market. So doing it on a much longer time frame can kind of, it makes it more high conviction when it fires off, but it takes a lot longer. It's a much slower signal. So you can see here that towards late stage bears, this blue curve starts to compress up towards this breakthrough level, right? We're still in the bear market firmly, but we're starting to see that the Z-score is then pushing into more favorable territory. So let's zoom in on a 5-year basis so we can see where we currently are. You can see that we've got, this is kind of the peak bear. And you can see that this too started back here in May, June, July. We have it starting to compress and get a little bit lower. We're seeing a little bit of additional fee pressure, not enough really. We haven't really got this thing breaking up above 0 yet, but we're starting to see early signs that alongside that initial transaction count and active addresses, there's a little bit, just a little bit of fee pressure starting to build. So again, one of those metrics that hasn't fired off yet, but something to pay attention to as it comes forward. You can see 2019, there was a little bit of fee pressure, but it wasn't enough to kind of initiate. You can see the difference between 2019 and the post March 2020 event, two very, very different environments. Okay, so the third topic, and actually one of, in my opinion, one of the most important ones, and this is just for on-chain analysis in general. This is the concept of profit and loss. Now, we recently rolled out, you'll find in the dashboard section, we recently rolled out a dashboard called Realized Profit and Loss, where we're in the process of rolling out an unrealized profit and loss, and I'll explain what these are, but the concept of profit and loss comes from price stamping. We can look at a coin when it was withdrawn from an exchange and we give it a price, right? Whatever the realized price of that particular coin. Someone withdraws at 10,000 and we wait till 50,000 and then they send it back to the exchange. They have realized a profit, right? They withdrew at 10K, they sold at 50K. Let's say they had half a coin. That means that they invested $5,000 up front and then they've sold that for 25,000 at near the top. Somebody else had to come in with that additional 20,000. So the realized profit is actually an indicator of capital inflow because someone had to come in with more money to buy that coin. Likewise, the guy that bought at 50,000 is now selling down here at 20,000. He locked in a $30,000 loss, right? Times the coin volume. So what you're looking at here, and this is the human behavior plotted out over time. When you have profit, capital is flowing into the system. When you have loss, capital is flowing out of the system. And then you look at it at scale. On an individual basis, sure, they may have bought their coin at 10,000 and withdrawn at 11,000, and they may have sold it, sent it into the exchange at 50 and sold it at 51. But that's at a micro scale. At a macro scale, you see these things play out remarkably cyclically. You see the behavior patterns of people, just like people buy the top, people sell the bottom, and we can use profit and loss tools to literally visualize both of those events. So I've got two different metrics here. We'll go top and then to bottom. The first one is the ASOPA. So SOPA stands for spent output profit ratio. And what it's looking at is of all the coins that are spent, we don't care about coin volume. We just care about, think about it per transaction. Per transaction, what is the difference between, what's the profit multiple? So 1.1 means that it realized a 10% profit. And 0.9 means it realized a 10% loss. So it's a ratio showing how much profit on average did the market lock in. Now, on the left-hand side, this is on a 7-day EMA. I like to use exponential moving averages for these types of metrics because the EMA means it's weighting it's smoothing, it's getting rid of the daily noise by putting an MA on, but it's also giving me, with an exponential, I care about what happened yesterday more than what happened a week ago, right? So exponential moving averages heavily weight more recent history and it decays back towards the later history. So on the left-hand side, I've got a 7-day EMA. This is my what I use for tracking short-term stuff. On the right, I've got the exact same metric, but full history on a 30-day EMA. So on the right-hand side with a longer moving average, this is the macro cycle. You can see that when this trades above 1, it typically sticks the landing and stays there for a bull market. When it's below 1, it typically stays there for the majority of the bear market. Now, the other thing that you can see is that these bottoms, here's 2012, here's 2015, here's 2018, March 2020 wasn't quite as severe, surprisingly enough, and here's FTX. All of these you can see are at similar levels, major capitulation events. The average coin that was spent locked in an enormous loss. And remember, because this is on a 30-day EMA, the flash event of March 2020, because it was an event, it was like a day or 2 days, these here were months and months of people going, get me out of this thing. I'm done. I hate this asset. I'm finished. So the amount of pain that was measured and flushing out of seller exhaustion that happens when this model at a macro scale is below 1 is telling you that kind of major capitulation event is in play. Now, when we break above 1 on a 30-day EMA, this is, and we are approaching that level. We'll zoom in a second. When we break above, it's at the very least time to start paying attention. It means that the market's starting to perhaps realize a profit. And remember, at a psychological level, no one's going home and telling their friends and family that I lost thousands of dollars in the market because it's, I bought high and I sold low. What we're starting to see is that transition back towards a market where there is sufficient demand inflow to absorb profits. People are able to take profits, which generates more volume, and liquidity attracts liquidity, and all these market things start to play into effect. It's never immediate, but that's the general structure of why we care about this stuff. So with that as context, we can see at the moment, let's go on a 5-year for this 30-day, we are attempting to get close. This means that on average, on a 30-day EMA basis, on average, every transaction is realizing roughly break even, right? We're heading back towards a neutral zone. What we're not seeing is top buyers, right? People from the 2021 cycle getting flushed out at scale. And you can see that here's the June sell-off. This got worse, right? All of these capitulations got worse and worse and worse. People were locking in larger and larger losses. Exactly the opposite is starting to happen. If we get this sustained uptrend, it means that people are locking in smaller and smaller losses, which means there's probably less people who bought the top left to sell, which starts to get into a bit of a seller exhaustion type pattern. So this is kind of a momentum to the downside. Here we're starting to see perhaps something to pay attention to. We actually want to see this thing bounce up and get back above 1. So zooming in on a 7-day EMA, you can see that here's the flush out of FTX. Here's that sustained period. We're starting to get this thing breaking above 1. You can see we've got the downtrend, which is now starting to move back into an uptrend. And remember, this is the same concepts apply in the sense that this is essentially human beings, right? Technical analysis is just fear and greed plotted against time. All we're looking at is all the pain, the joy, the euphoria baked into a price chart is people winning, losing, euphoric, greed, blowing their accounts up, all that stuff. It's all shown up in the technical analysis of a price chart. This is visualizing those very, very same things in the on-chain activity space. So you can see we've had this major capitulation here for FTX. You can see that it got worse and worse as the bear market went through, but it seems we're starting to improve, particularly as we traded sideways. Note here, FTX was massive, but the capitulation events over the course of the last, December and early January got less and less, and now we actually have a break above 1. So it's telling us that there's a bit of a regime shift that may be in play. Now, the very, very similar concept applies to the realized profit loss ratio, PL ratio. This thing here, rather than where SOPA doesn't care about whales and shrimps, they're all the same. It's just per transaction. This one here is now waiting for coin volume. So what you actually want is both of these things to trip over and say, hang on, we're now back above on a 7-day EMA, and we are in the process of breaking above on a 30-day EMA. So we're starting to get that momentum shift. We're seeing that profits are starting to be realized both at a per transaction level, but also at a per dollar value level. So it's telling you something about both cohorts. SOPA doesn't care about how big you are in terms of size. Realized P&L ratio does. So when you have both of them, it's telling you that there's a more macro scale trend shift that's in play. And one last thing is probably for a different webinar, we can focus on this, but note the negative retests of SOPA at a value of 1. These are people just saying, give me my money back. I'm selling at break even. I just want to get this tiny bit of profit. Get me out of this thing. I've had enough. So a convincing break of that market structure is something to start paying attention to. Okay, so that's the profitability. I would call that that's realized profit and loss. And by realized, I mean they're coins that are spent. That's the actual spending behavior. When did you buy your coin? When did you sell it? Let's compare the delta. That's realized profit and loss. The next topic is it's in the category of supply dynamics, but we're actually looking at who owns what and when. But we also introduced the concept of unrealized profit. These are the coins that have not been spent. Someone bought their coin at 16,000 and they're still holding it. So they're now in an unrealized profit. Someone else bought their coin at 50,000 and they're in an unrealized loss. So you can kind of measure this as the amount of psychological stress that people are still holding, or psychological euphoria, right? There's an incentive to sell. The lower the price goes, the more red you see in your portfolio. And there's also an incentive to sell the more green, right? When people are in a high degree of profit, they're probably as likely to spend as someone who's just immensely in the red. So the first model we're looking at here is the percent supply and profit. Now, the reason I want to start with this one is these large, sharp moves off the bottom, right? When you see these massive, massive moves in the percent supply and profit, as we've seen recently, what you're looking at here is that price has really only gone to the top of the range that we've been in since June. So it's a 7-month long range. Back here in 2018, I think it was about 6 months that we were down here. We barely got to the top of this trading range, and percent supply and profit was just moving upwards in a crazy way. The reason why is that this is telling us how much supply was capitulated by person A and thus equal and opposite acquired by person B. What we're seeing here is how much supply is in the foundation below us. These sharp moves off the bottom is telling you about that foundation, right? Because all you need is price to be 1 cent above that acquisition price, and you've now got a coin that's back into a profit. So that tells you a bit about the foundation that's below us. And generally speaking, we see multiple retests of these folks. We're seeing that their unrealized profit and loss gets smashed all the way through this bear cycle. But under the surface, those coins change hands. Someone who's now got a $16,000 cost basis is going to have an easier time holding it than a $60,000 cost basis. So you get a resetting. People return back to a bit of an unrealized profit. It's generally psychologically easier to hold coins in the green than it is in the red, right? Particularly when it's after a prolonged bear market. So that's the initial opener for unrealized profit and loss. There's two concepts here that I want you to take away. During bear markets, you get that changing of hands. The ownership structure moves from those who came for the speculation and the fun and the memes, and it moves back towards those who do the research, the proof of work, the people who have the high conviction. And this is not just Bitcoin. This is the same for any asset. I can't remember the exact quote. I'm going to butcher it, but there's a quote that bear markets essentially return stocks to their rightful owners. That's the process that's going on here. Those who have done the work and understand why the asset exists, the coins flow back towards them. It's a slow, painful, grinding process, but eventually the coins go back to the people who are going to treat them the best. So when we look at the total supply and profit, what you'll notice, and it may seem kind of intuitive, but what you'll see is that towards late stage bears, this thing starts to bottom out and you get a reversal back to the upside, right? When price starts to move higher, you naturally get more supply moving into profit. But think about this from a derivative perspective. If this thing is trending higher, it's telling us that price is going up and more people are going into a profit, right? Which, as I said before, the more people that are in profit, the more people go, hey, I'm in profit, and tell their friends, and word of mouth does this expansion, right? People get excited. That is what bull markets are. Bull markets are a spreading out of people going, hey man, this asset is great, right? It's the human expansion of what's going on in the market space. It's the same for any asset. Always has been, always will be. So when you have, this is on a 90-day EMA, so very, very long term, when you have a nice, long, sustained uptrend in the total supply and profit, it's telling you that we have people going into profit, prices helping them out with that, and you're seeing just an overall macro trend shift, right? It also, similar to the percent supply and profit, it's telling you that there's coin volume below you, right? Which means it's been acquired and it's sitting in the green. Easier to hold onto coins in the green. So an uptrend in this metric is a very, very simple gauge to say, are we in a healthy trend? And where you can see at the moment, we've come down, we've slowed down this bottom formation process, and we've got again, this is micro scale, right? So it's something to pay attention to, but we've got a nice little uptick. It's telling us that a bunch of coins just returned to a profit. Now, also note that this move up here, right, on our percent split, it's pretty big, right? It's put us basically into the middle of the range. Look how insignificant it is in terms of total coin volume. So on a 90-day EMA. So you can see that when these things start to trend, it trends, right? It really does get some upside momentum. And naturally, there's peaks and valleys and things happen all along the way, but this is just a really nice, simple gauge. Do we have upside momentum in the number of coins returning to a profit over a long enough time frame to make it meaningful? So that's another one we're paying attention to. Now, the last one, and then we're going to jump across and look at the summary and kind of bring all this stuff together. This is the realized HODL ratio, often known as the R-HODL ratio. So what the R-HODL ratio does, it's looking at the balance of wealth held by different cohorts. So there's two things in on-chain analysis that we do not have in any other field. Profit and loss, because we can measure coins with price stamping. We can measure when coins were acquired and disposed of. And lifespan. Lifespan is how long someone held their coins. I would love to know how long people in the stock market had held their coins at an individual micro level. You can start to see how many people have held their coins for 2 days, how many people have held them for 2 years, how many people have held them since the origination of the company. You can start to see how long people have held, because I don't particularly care if a bunch of people who bought yesterday sold tomorrow. I don't particularly care if someone who bought last week sells tomorrow. It's kind of day-to-day trade. I do care if someone who bought 5 years ago in the bottom of a bear market at scale, if they start selling, that's a whole different ballgame, right? There's a different weighting that we can apply to how long these investors have held their coins. So what the R-HODL ratio does, it takes the balance between people who've held their coins for over 1 year and the ratio of people who've held their coins for 1 week. At market tops, what has happened? The smart money who bought back here in 2015 at the bottom of the bear market at a point when the maximum wealth was held by people with coins older than 1 year, they are selling to people who are brand new. So you have an outflow of old money and an inflow of brand new money. The perfect recipe for starting a bear market. Too many people who have no idea what they're doing, and everyone who knows what they're doing getting out. So a very high R-HODL ratio, right? And you can see that our bear market, much the same as these were kind of peaks, blow-off peaks. Note that our bear market, this was one long sustained period where we did not have an improvement, right? We saw this is a mass scale distribution. We are seeing that the old money is getting out over a sustained period of time. We are seeing a long saturated period of people who recently bought. We're saturating this top section with new buyers, and note how quickly this thing collapses. So what this low value that we currently see is the exact opposite. This is telling us that the maximum coin wealth, the stocks have returned to their rightful owners. We are seeing a saturation of the holder base by people who have a long-term holding period. People who have held their coins for over 1 year are the dominant majority of people who hold. So that's just telling you something about kind of the saturation of the holder base. But what's actually more important is when this thing starts to move into an uptrend. So as we move back into an uptrend, that's telling you a couple of things. One, the smart money are smart. They understand the flow of the Bitcoin market better than most people. So what we're going to see when you see an uptrend in R-HODL, that is telling you that the smart money has essentially deemed there's a bit of exit liquidity. I can take that. I can take that. I can take that. And you get the, and obviously the amount that they sell increases with the bull market, particularly when we break the previous all-time high. This thing just rips to the upside. This is in log scale, by the way. So whilst it looks linear here, this is actually a parabola in real space. So what we're seeing is that bottoming out, a flow of funds back to their rightful owners, and the uptrend is telling you that there's enough demand for the smart money to say, you know what, I can take some chips off the table and I'm not going to blow this thing up. That's essentially what we're seeing. So a nice uptrend in the R-HODL ratio is what we're looking for. Okay, so that's the real thesis. That's the why. That's the components that actually go into this model. Now, what we're going to do now is just summarize, and then I can see there's a bunch of questions flowing in, and we'll get around to those in a moment. We've talked about the most important thing I want you to take away from this is the categories. Pricing models in green, on-chain activity in yellow, profit and loss in blue, and supply. Do we have a saturation and is supply trending in the right direction in purple? So within each of those categories, we've got two of those metrics. And what these colored bars, you'll find this particular dashboard, by the way, in our signals tab, recovering from a Bitcoin bear. Everybody with an advanced plan will get access to this. We are in the process of building out ones for surviving in a bull market, right? Looking for periods of micro overheated and dips and things like that. We're building one that's going to be trying to find those extremely overheated periods near tops. And we'll also be trying to find one that's like those big flush outs, major capitulation style events. So they're all in the oven. But this is this is kind of our first attempt. And please do let me know what you think of these things, because if some people work better with these visual styles, some people prefer the metrics, and we'll build stuff accordingly. So the real take home here is that each of these components, we can see our pricing models have both of them firing off. Our on-chain activity, we only have the new address momentum firing off. We do not have fee revenue. So that's kind of 50% of the way there. As we saw, our ASOPR on a 30-day SMA is in the process. It hasn't yet broken above, but our realized P&L ratio has. So again, 50% of the way there. On the supply side, we now have an uptrend in our R-HODL ratio. So R-HODL is now telling you that we do have an uptrend and it has some degree of sustainability to it. That's good to see. And on a 30-day trend for our supply and profit, we also have an uptrend. So what that all distills down to is we're starting to get a bit of a recovery in the signal down the bottom here. Let's zoom in on a 5-year basis so we can just see what's going on. Now, remember, this tool is not trying to pick the bottom. It's not trying to find the ultimate low. What we're looking for is, do we have a sustainable, multifaceted confluence across many factors that are disconnected, that are telling us that there is a healthy recovery underway? We're looking for that confidence. And remember, a value of 1 is typically telling you that it's starting to get really hot, right? The room, everything is firing off. It's starting to get pretty hot in here. And things that are good for a market recovery are also going to tell you that the market's getting pretty hot, right? So what we're looking for is the probability that things are starting to improve. That's what really this model is trying to assess. So the black curve is just basically between 1 to 8, how many of those metrics are firing off. And the color bars will tell you when both of those indicators are showing up. And a little snapshot here, you can see back here at the March, right before we had lunar collapse and all of this, note that the only one that fired off was blue, which is profit and loss. That's people selling to get their money back, right? So the same concepts, those concepts are applicable throughout on-chain analysis. We just happen to be applying them here to recovering from a Bitcoin bear. All right, let's jump in and have a look at some of these questions. Hopefully that was a useful session. Again, I want you to take away the why and the categories of this thing. Okay, what are my top 2 or 3 top calling metrics? So for top calling, let me get back to you on that one, because we've got a lot of ideas in the oven. And as I said, there's a dashboard in a similar format to this guy that we will be in the process of building. So let me actually get back to you on that one, just keeping it within the framework of a bear market. But there are tools that we're building for that as well. Essentially, everything you saw here, flip it in the reverse, right? Everything, if you want to see the recovery of a Bitcoin bear, you want to see the exact opposite at the top. Okay. What else have we got here? Yeah, so more in favor that we're at the end of a bear market than the middle of one. So the way that I look at this, and this is why I like unrealized profit and loss and realized profit and loss in particular, the reason why I like to look at those metrics, if we look at the unrealized, how much loss, and also you'll find this in the dashboard that'll be coming out very, very soon, the unrealized loss, if you're a hodler, there's a certain amount of pain, financial pain, that human beings can weather. There's only so far you can push us before we go, that's it. Just get me out of this thing. I've had it. I'm done. So there's only so far people can go. Unrealized profit and loss, particularly the loss component, is showing you how much of that storm people can weather. So this is why when we look at things like Nupal, this is why when we look at things like MVRV, net unrealized profit and loss, all of these tools are helping us understand what is the pain threshold that shook out investors in the previous cycle. Many, many of our metrics, at least from my perspective, have hit that threshold where, and again, we don't know what the future holds. All we know is how did the human being, the human mind, the ape brain that we all have that is unchanged for thousands of years, how did it react to that particular level of financial stress? And in many levels, we've seen people capitulate out with realized profit and loss. We've seen people hodl through immense pain, which is the unrealized profit and loss. We've seen many of these things reach these kind of extremes that have, at the very least, in the past, shaken out. They've been sufficient to shake out those last sellers. So at the very least, in terms of are we at the end of a bear market? The answer is no one knows. But when we look at all the metrics in context, it sure looks a lot like every previous bear market, right? When we get towards that late stage, we can see a lot of the same behaviors. But what that also gives us is a toolkit. What happens if it breaks, right? If we get some kind of change to that sequence, then we have to start thinking about it from a little bit different. But so far, it's almost been textbook, which is kind of interesting. Eventually, we'll write one of those. Okay. Yeah, so there's a question here. You wonder if the metrics are not enough to support the idea of the end of a bear and require time to get conviction. Absolutely. No, 100%. And this is the thing, right? It's all about that. There is no tool that will give you, this is the bottom, it's time. This is the top, it's time. What you're looking for is always a probability. You're looking for, and that's why I want to reinforce two things, the psychology. You're looking at the human beings of all the markets, right? The assets are different. The market structure is different. The monetary policy is different. The Fed is different. How you feel on Thursday is different. All of these things are different. But the one thing that is the constant in all markets is the human mind and the way that we react to fear and greed. And that's what we're looking for here. We're looking for, are the human beings behaving in a way that signifies we have overheated or undervalued? What has been the conditions in the past that has hit that psychological level? And really what we're using here is these tools to try and map that out, right? And then that's why this model here is called a confluence model. The more of them that are in play, the higher the probability. The longer that they're in play, the higher the probability again. But the longer that they're in play, the higher the probability we're also getting towards the late stage of this thing. So it kind of works both ways, right? It's all about probability and timing. In the sense that you're never going to know the exact number, but your confidence will grow. The more of these metrics trigger and the longer that they hold that level, that's really what this is all about. Make sure you get that confidence across a number of these things. So there's also a question here. Can you get the formulas for the metrics shown? Absolutely. So for anybody who's kind of looking for all these tools, I strongly recommend that you spend some time in our dashboard suite. You can see here that this is actually getting pretty extensive. What we have here is stacks and stacks of metrics, concepts, and ideas with text boxes to help you understand the topics, right? You can see we've got one here for on-chain activity. You can see we've got one here for pricing models. We've got one for realized profit and loss, and we've got one for unrealized profit and loss in the oven. We've got one for hodl wave dynamics, looking at that flow of funds between old and young. We've tried to categorize these things out and put all the metrics that you need to care about in one place. Now, if you ever want to inspect and see how these things work, the top right-hand side, there's a little magnifying glass called View in Workbench. Some of them are metrics, but the ones that have this little green plus sign here, this is telling you that this is a workbench chart. If you click this button, it will expand into Workbench, and you can totally dissect and see how these things are built, chop, change, substitute other things in, test. It's all about giving you those views. Okay. How do analysts determine whether market movement is a blip or a trend? Yeah, I mean, that's a really good question. And the answer is it kind of varies. It depends what you're looking at. Generally speaking, a trend will form into a bit of a trend, right? We saw that with the ASOPA model. March 2020 was a flash event. If you're looking to try and assess this is why I used for those models a 7-day and a 30-day. It's why we use momentum. If you use the momentum charts, like a 30-day moving average compared to a yearly, what you're looking for is your baseline is the yearly. And if the monthly is higher, that's a good sign. If your 7-day is breaking above and your 30 days in the process of breaking above, that's more of a trend. If your 7-day breaks above, but your 30-day is trending down, more of an event. So using clever moving averages, 7s and 30s, 30s and yearlies, stuff like that to compare those two is a really good way to assess event versus a trend. If they're both heading in the same direction, it means over a longer term, it looks like it's a trend. If they're heading in opposite directions, it typically is more of an event, which can then turn into a trend. But at the very least, you've assessed that gauge. Okay, question here on the perpetual swap market. There has been short liquidations. However, this is not, personally, I believe this is almost entirely a spot-driven rally. I think obviously there's always liquidations, but the reason why I say that is that percent supply and profit chart, that really, really strong move off the bottom, and it was ripping higher off price at 18K. So it went up from 16.5 to 18. And I think it was like a 10% price move, and supply and profit went up 13%. So that tells you that there was a spot market involved in this whole thing. So perps will always have a role. They will have more of a role next time we're up at these bull market highs. Right now, at least from my perspective, I think this is primarily a spot-driven rally. Are there any fake signals? There's always going to be fake signals. Kind of similar to what I was saying before. Certainly, tracking things in terms of moving averages is a really powerful tool to try and kind of narrow out some of these ideas, and kind of deconstruct what's going on multiple time frames to give you that little bit more confluence. So moving averages at a metric level, but also looking at multiple metrics that are telling you the same story, which again, the dashboards, if you're looking for which metrics should I care about, dashboards. Okay. There's a question here about weekly training. So maybe not weekly training, but certainly we are in the process of, the reason why this webinar exists is that we're trying to make sure we've got training coming out. There's a couple of things that we're working on in the background that will be a bit more kind of structured. You saw some of the topics. Now that we have our dashboards released, we're now going to start turning those into a bit more educational content and saying, all right, on-chain activity, let's understand why that matters. Profit and loss, let's understand why that matters. So to answer your question, there will be more stuff coming out. It will be coming out as quickly as we can ship it, which, most of the time there's something coming out each week. But we will be structuring that into a more tight process in the very near future. So stick around. Okay, what do we got? Last question I can get around to. How do I reconcile this with macro market forces? Great question. One that I get quite often. So there's a few ways I can answer that. The first one is understanding the macro. And again, my background is civil engineering. I just happen to have a passion for markets and obviously for Bitcoin. Macro market factors. I spend a lot of time personally just studying and understanding it, right? I'm no macroeconomist, but at the very least, I reconcile it personally by just being aware of it and understanding it. But if we actually peel back that onion one step lower, I think we would probably all agree that Bitcoin entered the world of macroeconomics back in 2020, 2021, rightly or wrongly. How it did doesn't really matter. I think it emerged into the consciousness of the Wall Street world as a macroeconomic asset. So as a result of that, and actually, I wouldn't even say as a result of that, before that as well. For me, I got really into Bitcoin. It was kind of what I kind of woke up to it in very early 2019. My behavior in the Bitcoin space personally, as a hodler, as a long-term hodler, was because of the macro environment. So my decisions and my observations about what's going on in the world, they are imprinted on every single UTXO I've ever touched, right? Did I buy that day? Did I sell that day? Did I hold it? Did I not? Did I spend it? Did I move it out of exchange? What did I do? Everything that I did, every decision that I did is inside the UTXO set. So there's many people like me. There's also many people who just came for the hype, bought, sold, get me out of this thing. All of those decisions are collectively contained within the UTXO set. On-chain analysis is pulling that database and turning it into information. So when you ask, how do we reconcile this with the macro market factors? What I would actually return and say is that all of the collective decisions of the hodler cohort and the speculator cohort, and in fact, any person who's ever transacted on-chain with Bitcoin or hashed, all of those collective decisions are contained within the UTXO set. So in a way, it's self-reconciling because the data and the way that people behave regarding Bitcoin, the asset, because what the data inside the Bitcoin blockchain is telling us, it doesn't tell us anything about the oil market. It doesn't tell us anything about Apple stock. What it does tell us is how people behaved with respect to Bitcoin with all of the macro information around them, right? We are all creatures who live inside a society where things are happening all the time. There's macro, like my macro environment here over in Australia is different to yours in the US, which is different to yours in China, right? The overall environment that we live in affects our personal decisions, and those personal decisions are getting baked into the Bitcoin blockchain. So in a way, it's somewhat self-reconciling, because the way that Bitcoin is being treated in response to the information, the stimulus that human beings are exposed to, that's essentially what creates the on-chain data set that we have in front of us. So anyway, I think that's pretty much all the questions we've got here. Thanks again, everyone, for tuning in. I really hope that this was a useful session. As I mentioned at the start, we will be condensing this thing down into we have a recording for it. So if you do need to come back and refer to it, you will. We'll put this particular webinar session inside a video, which will go inside that first dashboard that we had, and it will have backlinks to all of these things. If any of this stuff is kind of intriguing, do feel free to reach out, jump into forum. As I mentioned, everything here is available with an advanced plan. The big takeaways, if I want you to take away, is 1, it's all about human psychology. 2, categorize things out. On-chain activity is for X, profit and loss is for Y. Categorize things out and it will help you along the way. And to help you with those processes, these dashboards is essentially where me and my team are compiling and putting the charts and things that we care about and that we use day to day into those dashboards to answer those specific questions. Anyway, that's how we'll kind of wrap it up. But hope everyone had a great time, and we'll hopefully be doing this again very soon. Cheers.